Good morning, everyone. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities. Happy New Year and welcome back to Monday Minutes. Well, we started 2020 with a certain vision, and coming out of 2019, we had our views on the marketplace, in particular rates, just like many other participants. But my 25 years of trading U.S. rates in the financial markets, you're always on the lookout for unexpected. And some of the geopolitical risks that were in the marketplace in 2019 came front and center late last week. So let's talk about that a little bit in terms of market reaction, flight to quality, and in particular, what it means for U.S. rates, outright, curve, and regarding the Federal Reserve. So from an outright perspective, if you look at 2019, we traded in a range of 150 to 2% late in the year. And toward the end of 2019, with some of the tailwinds turning into headwinds, some of the progress on the trade front, and some of the euphoria with regard to risk assets, 10-year yields were buffering up against the upper end of that range. Now we sit closer to the middle of that range, in at around 175. And since the geopolitical risk of late last week, 10-year yields have come in about 12 basis points on an absolute basis. When you look at the yield curve, right, you look at the Federal Reserve now on hold. They've been on hold now for a couple of months, and they've signaled that they plan on staying on hold for 2020. So that dynamic, and we've been talking a lot about the yield curve. We had fairly significant steepening late in the year. We actually broke through some key levels late last year, and now we've since come back through those technical levels, and we're well within the range that we saw in 2019. So we expect the curve to be very directional going forward. And what that means is the volatility will be expressed with the Fed on hold more further out the curve than in the curve. Unlike 2019, we were going back and forth between 25 basis points and 50 basis points in terms of Fed easing. So we still feel the curve will be somewhat directional. And if you look at a day like today where 10-year yields are rallying, we're seeing a flattening in the 2s-10s curve. With regard to the Fed and with regard to the geopolitical risk, now that's heightened in the marketplace. On a short-term basis, if you look at the OIS curve and the forward pricing for the Fed funds rate into 2020, right now we have roughly 25 basis points priced into the marketplace, and that's been fairly consistent over the last couple of months. We don't really see anything over the last 48 to 72 hours to really change the Fed's posture toward the marketplace. The Fed speak over the weekend was more about inflation and managing downside risks, another theme that we've spoken about, which will more than likely keep the Fed on hold on a short-term basis. But with regard to the geopolitical risk, it's still uncertain how this is going to play out. So we don't really see any change in the Fed's posture with regard to their current stance of being on hold. Having said that, depending on how the events unfold in the coming days, in the coming weeks, should there be implications for the real economy, that's when we think you could potentially see a change in the Fed's posture toward potential more easing for 2020. I'm Greg Faranello, and this is Monday Minutes.